Okay then. So I can still see the numbers are clicking up actually. Um, quite good attendance today. So yeah, thank you for logging in this morning. Hopefully it's useful. As you know, it's about inheritance tax. It's not necessarily going to be the most fun and exciting session, and but hopefully it'll be informative nonetheless. So um, I can see a couple of names that have logged in last year. So um, I would like to tell you there's been exciting new changes and the world's completely different than it was. But actually, not much has changed over the last year. We were told in the press there was talk in the spring budget that inheritance tax may be being removed, and we've heard this before, and yet again there's been no change. In fact, there's been very little change over the last 14 years. The allowances and things that I'll explain to you in a moment have been frozen over that time. But you can also imagine inflation's been high over the last 14 years. House values have increased. So what it actually means is without the government having to announce changes to the tax regime for inheritance tax, more and more people are being caught by this. So, £1 million estate was less common in the past, but obviously these days, house prices plus other assets mean that more and more people are being trapped by this. So it's an area becoming more and more relevant until things have changed. The allowances look like they were announced to be frozen until 25. So the future remains to be seen. But what we always do is just plan on what we know you know, based on current legislation and tax rules. But anyway, as an introduction to me, for those of you who don't know me, I'm Paul Johnson. I'm one of the advisors at the practice. I'm a chartered financial advisor. I work with clients alongside Adam and the rest of the team. Adam is my brother, in case you didn't know. He's the owner and director of the company, and the other advisors here on the screen all help advise their own sets of clients. Some of them are logged on the call today, but Adam's new to the practice. He's a mortgage advisor. So more of you may be dealing with him over the next few years if that's an area you need help with. And yeah, those of you who are existing clients already will be already connected with one of these other people. And so really today I'm going to give some information about inheritance tax and the rules, and also offer a kind of a high level summary really of the range of solutions that you can employ to avoid inheritance tax. If you, as a result of today, you want to speak to someone, one of your advisors, or anyone on the call, can either contact us and arrange a meeting, or if you wiggle your mouse, there's a Q&A button that comes up. And if you have any questions today, I'll do my best to answer those at the end. If they're niche or quite personal, it might be better to kind of pick up as a conversation rather than going into too much detail. So inheritance tax, well, is not a popular tax. I think that's fair to say. We pay a lot of tax, national insurance through our working lives. We accumulate whatever wealth we've built up, and then when we pass away, the government want another slice of the pie. So for obvious reasons, not very popular. And that's kind of, it's interesting actually, because it's one of the lowest revenue taxes for the government. So it would be an easy one for them to remove, but also it's also seen as perhaps a tax on the more wealthy. So it's quite, taxation's always got it's always political and always will be. But for now, it's there, and this is the situation I'm going to describe today. Now, the headline rate really with inheritance tax is, people talk about £1 million. Now, essentially, you have some allowances, and over that, you get taxed at 40% over the allowances. Now, each person will have a different allowances based on whether they're married, whether they have property, whether they have children. The situation varies. So the headline rate of £1 million doesn't apply to everyone. So that's one of the first things I get to kind of establish. So we've all got something called a nil rate band. And the nil rate band is the amount of stuff that you can leave in your will without paying any inheritance tax. and that's currently 325,000. Now, historically, over that, everything was taxed at 40%. The one change that has happened back in 2017 was they brought an additional allowance called a residence nil rate ban, and that's 175,000. Now, the maths is crazy to put together. 175 and 325 neatly make 500. So if you're a married couple and you have two lots of 500,000, that's where the £1 million headline allowance comes from. Now, the nil rate band is yours. The residence nil rate band is dependent on some other factors. Now, there's firstly, in order to have it, you have to have property, to have to leave or had owned property and leave that in your will. So if you don't own a property, you obviously don't get those allowances. The second thing is you need to leave it to linear descendants, the property that is. So if you don't have any children, you don't have the residence nil rate band. It can be children, stepchildren, grandchildren. It can't be nephews and nieces. So for some people, their allowance is 325,000. If you have children and you have property, your allowance is 500,000. So you can see there's quite a variance there. The other thing that catches people out is if your estate is over 2 million, you start losing your residence nil rate band. It's a calculation. Every £2 your estate is over 2 million, you lose £1 of your residence nil rate band. So an example, you had an estate of 2.1 million, you're £100,000 over, so you lose £50,000 of your residence nil rate band, and that keeps tapering away. So if a couple had £2.7 million estate or more, their entire residence nil rate band is gone, so they would be left with a £650,000 allowance. So that band between 2 million and 2.7 million is a 60% tax band. So should be avoided where possible. The issues then. So the first thing is that, as I mentioned earlier, is property. The value of homes has increased and will on average increase over time. I know things have been perhaps the other way in some areas in the last year or so with high interest rates and everything that's been going on. But over time, it's fair to say a solid, tangible asset like a home is going to increase in value. The other thing, the bit that we're told about ISAs is they're tax-free, but actually they're not subject to income tax on dividends. They're not subject to capital gains tax on growth. But when you pass away, ISAs are subject to inheritance tax. But that's also true of your savings, bonds, and lots of other unit trusts and any chattels you have, movable objects, cars, and anything you have. There's not disowned by you personally, and I'll come back to that in a moment. So it's all your assets essentially. And one of the things people may not be aware of is where you pay inheritance tax is basically based on where you're domiciled, and that's kind of where your home is. If you've always lived in the UK, you're UK domiciled. If you've spent 15 years out of the last 20 in the UK, you're deemed UK domiciled. If you've lived abroad and spent different times in different countries, or maybe moving abroad, then it's slightly more nuanced, and there's these sufficient ties tests. Gets quite complicated, so that's something just to establish if it's relevant to you. But if you are UK domiciled, you pay inheritance tax on your worldwide assets. So if you had a holiday home in France or Spain, you still pay inheritance tax on the UK on the value of that property. So the other thing to include is gifts made in the last 7 years and potentially the last 14 years can be dragged back into your estate. As I'll speak about in a moment, there's the rule most people know that if you give money away, you have to survive for 7 years for it to fall outside of your estate. If you pass away in that time, then it can be clawed back in terms of doing the calculation for inheritance tax. And there's some there are some examples where you can look back 7 years and need to look back another 7 years, hence knowing the previous 14 years can be relevant. So all that stuff comes in, and then when someone passes away, we look at their taxable estate. There are a few things that don't form part of their taxable estate, things like trusts, which also includes pensions, and not everyone's aware of that, but pensions are not subject to inheritance tax. But I'll mention that a bit later on. So once you've calculated your taxable estate, then you can start looking at ways to mitigate it. So these are some of the issues. One of the other things that comes up a lot is buy-to-let portfolios, or just owning buy-to-lets. You know, the trade-off happens later in life when people have got inheritance tax liability, potentially over £2 million. So there's that 60% bracket that's going to cause them, cause a lot of tax to be paid on their estate. Now, the people say, well, I'll give my buy-to-let away, or I'll sell it. Now, the issue then is you're going to pay capital gains tax. Even if you gave a house away for no cost at all, you gave it to a sibling or a child or a grandson or whatever, you still pay capital gains tax on that. So there's a potential where you give a property away, you pay capital gains tax, you may give that money away but don't survive for 7 years, and you pay inheritance tax as well. So it's quite a difficult situation, especially if you've owned property for a long period of time. The gain can be quite significant, and as we've seen on the news and in the budget, the capital gains tax allowance was 12,300. That's the first bit of gain you can have before you start paying tax. And then they halved it last year. Then this tax year, they've halved it again. So it's only £3,000 now. So it's very small. More and more people are going to get caught by that. So it's a difficult area to plan around when you've got property. And obviously, we're looking at capital gains tax versus inheritance tax. But again, that's something, if that affects you, to probably do some in-depth calculations and really get a clear sense of your options. So the good news about this is there's a few reliefs and allowances that make inheritance tax less of an issue for some people. And one of the things to say actually is, out of all the taxes, this is the most avoidable. There's lots of things you can do and lots of plans you can take to reduce your estate. So one of the things to start off with is, between a husband and wife or civil partners, any gifts you make in your will to each other are not subject to inheritance tax. So if someone passes away and leaves their entire estate to their spouse, there's no inheritance tax on first death. Now, on second death, the estate will be tested against inheritance tax, but the allowances of both partners can be used. So if I passed away yesterday and gave my estate to my wife, she would also inherit my £500,000 allowances. So on second death, she would have the whole £1 million allowances to use. So that's useful. If you're not married, you're just cohabiting or not in a relationship, obviously you don't have that other person's. But if you're living together, then it does make inheritance tax planning more complicated. So many clients there's lots of clients over the years, we've explained the unromantic but important tax advantages of being married. One of the other things you can do, as I'll talk to you about that, I'll show you the actual figures on the next slide, but there are a number of gifts and gifting allowances that you can do and make over time, which will reduce your estate and also outside of your estate. There's also certain businesses and farms and heritage properties, as I say, that are not subject to inheritance tax. If you think about it, if a farmer might own significant amount of land, it'd be worth a lot of money. If they had to pay inheritance tax on that, the farm would need to be cut to pieces to pay the tax. And on every generation, it just wouldn't work. And the same for businesses. If you were passing your business on to your children, and there's a massive tax bill, it just wouldn't work. So for the sake of GDP and growth and business continuity, in most businesses and woodlands and farms are subject to a relief from inheritance tax. And I guess the two exceptions to businesses, because actually this is quite relevant, in those dealing in land and dealing in investments. So if you've set up a limited company and you to hold buy-to-let properties, that is still subject to inheritance tax. So it's not a way around it. And also, if you set up an investment company for investments, that's not a way to avoid it either. So what are the concerns really? So it's all very well avoiding inheritance tax by giving money away, but what if you need it? Giving away buy-to-lets to the next generation might save inheritance tax, but what if you need the income? Um, Also, with time, what if someone was in their mid 80s and they were concerned about their health? So 7 years might be stretching the longevity. Lots of people don't like complexity, especially as we get older. I speak to lots of the next generation who say, can you speak to my parents about inheritance tax? Speak to the parents about inheritance tax, explain the rules. They all understand it, but they don't want to take any action. They just don't like the complexity of it, um, and that's fine too. Some people have a very low tolerance to risk, and whenever you mention investments, and they're concerned that that as the standard warning in anything you do with involving investments can go up or down. You may get less than you back than you invested, and past performance isn't a guide to future returns, and all these scary warnings puts people off, and that's fine. It's investing's not for everyone. So if some of the solutions involve investment, then they're not going to be something that particular not be relevant for that particular person. So and in some examples, you need the income from assets to maintain your standard of living. You can't, if you gave away significant funds or you gave away property or anything like that. Well, what about the income? So there's a few issues there, but the good news is most of these can be solved. There's a number of different options or combinations of options that can be used that are relevant to each individual. Um, so you start off with, firstly, to quantify, do you have an inheritance tax liability? I speak to people, will writers refer clients, can you speak to my client? They're worried about inheritance tax. You speak to them and they haven't got inheritance tax liability at all. But so the first step is quantify if it is an issue, it's going to affect you. And that should always factor in as well potential inheritances that you may get. If you have an estate, let's say of 900,000, and you say, okay, we're fine, we're probably going to be fine, and we can do something about it later in the line, later down the line. But there's money that may be coming to you. There's a really good opportunity before that estate passes to you to alter the will to avoid it falling into your estate. So your parents could pay inheritance tax, and then you pay inheritance tax, then your children pay inheritance tax. And that's basically using trust planning. And with a well-written will, it can be avoided. It doesn't mean that you can't benefit from it. As an example, a couple could instead of leaving it directly to their children, they could leave it to a trust of which their children are the beneficiaries of. So the children can still benefit from the trust, but it doesn't fall into their estate for inheritance tax. Again, that is something to discuss probably more with an individual if that's relevant to you, but it's really key to get done. And even if someone's passed away, you have a 2-year window which you can look back and change their will through something called a deed of variation. It's more expensive than just changing your will, but it can obviously, in terms of tax saving, you can save clients hundreds and hundreds of thousands of pounds in tax through inheritance tax planning. And the same with getting the will right. People often I don't no one likes, well, it's a worldwide problem. We don't like talking about money. We're not comfortable about it. We're also not that well, lots of people aren't comfortable talking about death. So you put the two things together and you can see why lots of people kind of sit on their hands, bury their head in the sand, and don't actually take action, which is a shame, but I guess that's society, isn't it? Um, so once we've quantified that there's an issue and we've quantified there's an inheritance tax liability to deal with, then we say, well, we can look at the options, but the key part is what income do you need? What access to capital do you need? And those two questions are really key to what solutions that we offer. And one of the things we normally do, or we always look to do to start off with, is just looking at your gifting allowances. Now, if you've got a large inheritance tax liability, this isn't going to solve the problem. But like with all things in financial planning, there isn't one big brushstroke solution that solves everything. It's a combination of lots of factors that add up to having a significant interest. significant difference, sorry. So the annual gifting allowance is quite well known. Each person can give £3,000 away to anyone they want, and it's immediately exempt from inheritance tax. If you didn't do that in the previous tax year, you can carry forward last year's allowance. So you could give away £6,000 this year and then £3,000 every year thereafter. So a married couple with no previous gifting could give £12,000 away and then £6,000 every year. And you can see over time, £60,000 plus the growth that you may have earned on that, it does build up. Obviously, gifts to charity, as it says there, immediately exempt, and that can be done in your will as well. The one on here that's really underused is the gifts out of regular income. Now, if you earned 40,000 or had £40,000 a year of income, state pensions, private pensions, or buy-to-let income, but you weren't spending it, you earned 40,000, you had £40,000 of income, and you were spending 30, you had a surplus of 10. You can give that 10 away every tax year, and it's immediately exempt from inheritance tax. Now, you have to, it's worth, if that is relevant to you, it's worth documenting. It has to be income. It can't be depleting savings. They can't leave you destitute. So you can't reduce your standard of living. To make a regular pattern of gifting, as long as you've documented and your executors know about it, that's a really effective way of reducing inheritance tax on your estate or stopping your estate building up. The small gifts allowance, again, it might seem small, but if you give £250 a year to every grandson, grandchild, nephew, and niece, obviously that builds up. Just to be aware, you can't give the £250 away to the same person as you gave the 3,000. It has to be a different person. But again, these are all they're all immediately exempt. So a good, effective inheritance tax mitigation strategy is just to keep using these every year and making the best of them. And if you really if you look back at here, the gifting that you make can potentially save 40%. What do you do with that money once it's been passed? You can give money to anyone you want, but if you're giving money to children or grandchildren, you could put it into a junior ISA, for example. If you have a young child, if you put £3,000 a year away until they're 18, plus the compound growth, that's a significant amount of money that could really, pay for university, school fees, pay for a deposit on a house, or a really valuable gift. But if you really want to push the tax to the maximum, not only can you save 40% inheritance tax, but by placing it into a pension for a child or for anyone really, you can save another 20 or benefit from another 20% tax relief on the pension contribution. So you don't have to earn anything to put money into a pension, but you are limited. So the limit is £3,600 a year. So if you gave, using your annual gift allowance, £3,000 or just under 2,880 to a grandchild, they then place that into a pension. They would then get a 25% uplift up to 3,600. So saving inheritance tax, but also benefiting from the tax relief. And then you leave that to compound growth to age 60. You can see that's a significantly efficient bit of tax planning, and also when that the power of what that will be in 60 years' time will be significant. The downside to the pension over the ISA is you can't access that. Where it's 55 at the moment. It'll be 57 in a couple of years. So there's a trade-off between when you think the money would be useful. For my mind, I've put money into a pension for both my sons the minute they were born. The state pension age has been creeping up, 65, 66, 67, 68. I imagine it will probably be 70 or something by the time they get there. I guess I'm hopefully starting the option of them retiring before that age, or at least putting them on the right track. Now, trust planning is quite, people misunderstand that. Is essentially it's like a limited company. It's just a legal personality. You put money into a trust, and it allows you to make a gift, but also keep control. Because actually, just one thing I haven't really covered actually, if you want to give more than the annual gifting allowances away, you can give anything you want away. It's up to you. You could give £500,000 away today. What happens there is if you gave £1 million away, the first 3,000 is covered by the annual gifting allowance. The other 497 is what's called a potentially exempt transfer. Basically, it says starts a 7-year clock, and after 7 years, that leaves your estate. You could give it to them personally, directly to them, or you could give it and place it into a trust. The reason people use trusts is it allows you to retain some control. So you could say, you may have, I don't know, a son or a grandson or granddaughter who's early in their 18, 19, may not be at a stage where they're going to make the best decisions with their money, but you also want to start that 7-year clock as soon as possible. So you place the money into a trust, and then you can be the trustees. So you are in control of when and how much is passed to whoever the beneficiaries are. And you can name a range of beneficiaries. You can children, nephews, nieces, grandchildren, future grandchildren. But that just gives you the option of passing it over to them when you think is most appropriate. Now, for some people, this is another solution that's relevant. For some people, as I spoke about earlier, they have inheritance tax liability, but the assets they could give away are providing them with an income. So to solve that problem, there's something called a discounted gift plan. Essentially, it works like this. You gift money into a trust, into a discounted gift trust. After 1 year, you get 4% income for the rest of your life. So for every £100,000, you get £4,000 income, and that's fixed for life. So if you have assets that you need to remove from your estate to save inheritance tax, but need an income, this is a really good solution. The benefits of it obviously are you retain the income, but also start that 7-year clock for the value that you've placed into the investment to leave your estate. So again, this can save significant amount of inheritance tax, but also give you the right to retain an income for life. It is fixed. The income can't be increased, decreased, or changed. Even if you don't want it, you have to take it. But as a result of taking an income back from the trust, HMRC say, well, actually, you're not in this example, £250,000. You start the 7-year clock for £250,000. You're not actually giving £250,000 away because you're going to get some back as this 4% income. So they apply a discount straight away. So if I just look at that table now, for a 70-year-old, they gave £250,000 away. They apply a discount of £107,000. So what that means is the gift isn't considered to be 250,000. It's only considered to be 143,000. So you save 42,800 inheritance tax immediately on day one. And obviously you can see the spectrum there. So immediate discount, so initial saving, so survive for 7 years and a big saving, but also retain the right to an income. The next thing is, this is called a loan plan trust. So this is slightly different. It's more flexible, but probably not quite as efficient for inheritance tax. On this type of plan is for someone who may need, the example up there talks about may need to fund for care later in their lives. It could be for any fund. It might be just because you don't know when or if you need the money and you want to have the flexibility. And that's what the loan plan trust provides. So under this scheme, you put your money into the loan plan trust, and then you don't have to take an income from it. It's up to you, but you can recall the loan at any point, either in sections, in chunks, or as that regular income. That is completely flexible, and you can stop it if you don't want it. So the planning kind of works like this. So you loan the money into the trust, and over time, the value of that is held. An investment bond is held within the trust. You can use any high, medium, low risk portfolio of your choosing. Over time, the value of that investment will grow, and that is outside of your estate. But also, over time, if you recall the loan either as I say, regular payments or lump sums, then that obviously brings the outstanding loan down over time. So the plan is, in the future, the entire amount will be outside of your estate. if you don't need the money, you're not going to spend it. At the very least, taking out enough to use the annual gifting allowances is good tax planning. Recall the loan and recall part of the loan each year and gift that away, then removed from your estate. But it is key to understand, if you don't recall the loan at all, the actual amount you've loaned is still inside your estate. It's only the growth that's outside of your estate. So you really do need to record it and spend it at some point. And again, I mean, sometimes we've done planning with people where they put some money into a discounted gift plan to get some income, but they put some money into a loan plan to stop the problem getting bigger, but also know they can recall the capital. So sometimes a combination of these things is effective. Now, both those two things, as I've mentioned, you use an investment bond within the trust. And if you're of the opinion you don't want to take any investment risk at all, you've got no tolerance to risk, then a solution to that is a whole of life plan. Now, essentially what this is just a life insurance policy. We've all taken out life insurance policies probably at some point to protect our family or to cover our mortgage. And if hopefully we haven't claimed on those, because that means we've survived, and then our mortgage is paid off and they end. And so it's good news that you haven't had to claim on it, but essentially you've lost the money that you paid in premiums. A whole of life policy is different. What this does is it guarantees that it will pay out whatever the sum assured is, whatever the level of cover that you've taken out is when you pass away. So what you would do, because inheritance tax is free between husband and wife, you set it up as a joint life second death policy. So what that means is if a husband passes away, his estate then goes to his wife. When she passes away, then the life insurance policy pays out. Now, if you're 90 and you're getting near to the average life expectancy is around that in the UK, if you're 90 and your life expectancy is quite short, if you want £1 million worth of cover, you can imagine how high the premiums are going to be, somewhere near £1 million. So it is something to consider and look at. But actually, in most examples we look at, it turns out to be quite a good opportunity. So here's how and here's why. So for an example, a married couple have an estate of 1.5 million. So they're £500,000 over the allowance. So they're going to pay a £200,000 inheritance tax if they don't do something about it. So what you can do is take out a £200,000 whole of life policy. So you're guaranteeing when on second death, when the estate is administered, £200,000 is available to the executors to settle the inheritance tax, and that means the entire estate can pass without any further reductions. Now that has a number of benefits. Firstly, as many of you may have experienced probate, but it is quite a headache. It takes a long time to sort out, and if you don't have enough liquid assets to settle the inheritance tax liability, if you're trying to sell a property, it can take years before the estate is passed to the next generation. By setting up a whole of life policy, you haven't solved the problem, but you have provided a sticking plaster, a solution to pay the tax. But you write it under trust. So immediately on second death, you provide the death certificate, the funds are paid out. The executors immediately have that money so they can settle the IHT liability straight away. So you don't have to wait for properties to be sold, shares to be sold, or whatever else would be involved. And in this example then, so the policy for £200,000 for this fictitious couple, I mean, we have done a quote, so it's based on average health couple, non-smokers, I should say, in their 60s. So the premium was £213.50 a month. So a reasonable sum to come out each month. Now, over time, obviously, the amount that you've spent on this insurance policy will build up. But actually, if you look at £200,000 worth of cover, in this example, they'd have to live to 138 before the amount they've spent on premiums is equal to the £200,000 of cover. The average life expectancy is around 90. And at that stage there, they would have spent around £75,000 on premiums. So what you're actually doing, not only are you the cost of the premiums, say £2,500 a year, is leaving your estate, so it's reducing the amount of wealth that you have subject to inheritance tax. You're also kind of putting it into an IHT-free account that's guaranteed to pay out £200,000 in the future. Obviously, the sooner the second death occurs, the better the value of the policy. But obviously, we all hope to live for a long time. So the sweet spot really is somewhere further down the line, I guess. But the reality is no one's going to live to 138. So for most people that we look at, actually, this is a really efficient vehicle of providing a solution. And again, no investment risk. There's no need for people to have to get involved in too much complexity or worry about, ongoing charges or anything like that. So it's a really simple and clean solution. Obviously, it's subject to underwriting. If someone has ill health, then the cost of the premium will be increased. If they're a smoker, there's various medical factors which will obviously mean your longevity is reduced, and therefore the premium is increased to reflect that. But just always something to consider. Again, these are all a range of solutions, and again, combinations of them is sometimes the best way to solve this. Now, this one looks quite complicated, but actually, again, it's quite simple. You place your money into the trust, like the discounted gift plan. You start the income, but let's say you didn't need the income, and let's say you didn't have enough liquid assets to place into the trust to bring your estate below the threshold. What you can do, there's two elements or three elements to this. So the first element is you place the money into the trust, and that starts a 7-year clock before it leaves your estate. But what if you pass away in those first 7 years? Then it falls back in and there's tax to pay. So you use the 4% income from the trust to take out the second stage, which is a 7-year life insurance policy. Life insurance providers have set up specific policies that basically match the decreasing amount of inheritance tax you pay over 7 years. Essentially, if I gave £100,000 away for the first 3 years, it's inside of my estate. Then after that, the actual tax falls by 20% a year every year until 7 years, and it's down to zero. The life insurance policy matches that. So if you took out, you set one of these plans up, you put the money into the trust, you survived for 4 years, passed away, then their value falls back into your estate. The life insurance policy is equal to the inheritance tax liability on that. So it basically, you get you from day one, you've solved the problem. But the other part of it, the third part, is the rest of the income from the 4% income that the trust is provided. You buy a whole of life plan, and then that would help solve problems, tackle the issue of the wider estate. So quite a neat bit of planning, and obviously dependent on whether someone needs income and capital, everything else, it may or may not be relevant for you. But just another kind of tool in the armory that we can employ to solve the problem. Now, this is a different and much quicker way of removing value from your estate. As I mentioned earlier, certain businesses are subject to either 100% or 50% discount to inheritance tax through business relief. So what providers have realised is that, so if I own a shop, or if I own a warehouse or something like that, and it's subject to 100% relief, and you only have to own it for 2 years, then what they've done is they've set up a company, and they buy lots of different companies within it. This solar farms, wind farms, storage units. Sometimes it can be lending, a whole range of generally quite boring and safe assets. But the real purpose is, as long as they all qualify for business relief. So if you hold these assets for 2 years rather than 7, then the amount you've invested is exempt at that point from inheritance tax. So you can imagine someone who's ill health or very elderly, this is a much faster solution to reducing your estate. Now you can, again, lots of the providers have a life insurance policy linked to it, so you can take out a 2-year life insurance policy. So you put £500,000 in, there's a potential that you could pay £200,000 inheritance tax if you die within the first 2 years. So you take out a two-year £200,000 policy alongside the plan. So essentially, day one of the investment being set up, you solve the problem. Obviously, you pay more for having that premium covered for the life insurance than you would if you didn't. But again, it's just relevant to the individual circumstances. But this is a really good opportunity. There's risks involved because it's investing, and some of them are smaller companies, and they're all UK based. There's a concentration risk there. This chart just shows the potential survival rates for people at different ages. Obviously, as you'd expect, the older you are, the likelihood of surviving 2 years is much greater than surviving 7 years. I guess that's pretty obvious, really. Yeah, so I just put this slide in just because when a lot of the work we do is helping people build towards their retirement and also take income down during retirement. And inheritance tax is something you can consider later on, but it's always in the back of your mind. It's always something that you need to consider when you're making decisions, even in your 40s. There's what to do with your money. There's benefits of ISAs and pensions, and there's the ISA is immediately accessible, but the pension has tax relief. But as I mentioned earlier, pensions are free of inheritance tax. So the more money in your lifetime you can put into a pension, the less of inheritance tax liability you're going to have later on. You can build up a massive ISA portfolio, but also then actually create a massive inheritance tax liability. The same money placed into a pension benefits from tax relief, but it's also held within a trust, so it's not part of your estate. So you have an opportunity. It's the best trust in the world. If you put money into a pension, you don't have to wait for 7 years for it to leave your estate. It's immediately outside of your estate. If you normally put money into a trust, you basically give up control of it, and you may be able to take the income with a discounted gift plan, but essentially you've given up control. With a pension, is yours. Once you're 55 or soon to be 57, you can take funds from it. There's tax within trusts. With a pension, there's no capital gains tax on the growth. There's no income tax on the dividends from the equity portfolio. So not only are pensions a really tax efficient vehicle, you get tax relief going in, but when it comes to later in your life, inheritance tax wise, they're amazing. You can pass this. If you don't spend your pension, it then goes IHT free to the next generation, and they have options to keep it as a pension. They can take it as a lump sum. The rules change whether it's you pass away before or after age 75, but essentially it can go down through your bloodline and be protected from inheritance tax, but also be available. So we're heavily steer people towards pensions for all those reasons. Also, just to provide more freedom and flexibility in retirement. But when you come to spend your money in retirement, pensions are generally the last thing we would use because of the IHT saving. Obviously, it's completely depends, specific down to the individual. So it's something relevant there. One of the other things people don't, interest rates are high at the moment. There's no debate around that. Whether they stay high remains to be known. There's lots of speculation about when interest rates are going to come down, and I think speculating is dangerous. So we'll just accept that at some point in the future, there's a possibility that interest rates may be lower. Back end of 2021, the rates were incredibly low. Equity release is an option for lots of people. If you want to stay in your home, but you have the house, your property home is causing an IHT liability, you can take equity release and gift that money away, or spend that money, or gift other assets and take equity release to live from. Now, that allows you to stay in your home, but also allows you to remove value from your estate. The interest rates are very high at the moment, so it's not an option for everyone, and it's probably not the best time to do this at the moment with 6-7% rates. But when we've previous to in 2021, we're them doing rates which fixed for life at 2.1%. You can see then in those circumstances, and if we return to that sort of level, there's a really good opportunity there. Again, subject to all sorts of caveats about compounding growth on the equity release and everything else. So yeah, so part of the wider planning really is we can help. The earlier we start thinking about it, and the sooner you take advice, I suppose, the less of a problem later on. And that involves, always involves the next generations and the generations above and below, and kind of the whole family should really be aware of this. And the more you can openly and confidently and happily, I suppose, you can talk about inheritance tax, intergenerational wealth with your family, the less of an issue it's going to be. There's no need to give the government lots of money as an inheritance tax. There's lots, as I've just shown you, lots of different options that we can use. And the more time we've got to do something about it, the more likely it is to be effective. As I say, 7 years is fine for most people. So yeah, that's really that. A lot of mentions of tax, and as I said, not particularly exciting topic. So thank you. I can still see a good number logged on. So hopefully everyone's still awake and didn't get themselves too comfortable. There's a couple of questions come up there. So if you want to type anything now, I'll go through those. But just while I can see a couple coming in. The next one is actually building on from this. The next one's going to be on the 28th of June. It's holding difficult conversations with your parents. And that kind of relates to some of the things that I've spoken about today. So if you're on the call today, this might be something relevant for you or someone in your family. And then we've got the one in September on long-term care. So I'll just have a quick look at the questions. If anyone's, if feel free to go. Thank you so much for giving up your time this morning. Please get in contact. Obviously, if you want to have any questions around this, we've got information we can send to you. We've got a kind of a brochure summarising what I've spoken about, and obviously we're always happy to have a meeting and talk through your options. And again, if anyone else is affected by this, please feel free to pass me your details. So let's have a look at the question. So regarding the discounted gift trust, I understand that there's some tax to be paid after a number of years, I believe. So how much you place into a trust, there can basically, if it's a discretionary trust, which is what we would use, because for the IHT to be effective. Now, if you put more than your £325,000 nil rate band in, there can be, it's called a chargeable lifetime transfer when you put money into a trust. If you give more than your allowances away, there can be tax to be paid. And it's not after 7 years. So, okay, if I put £500,000 into a trust and I wasn't married, then the £175,000 can be subject to a 20% charge. Then every 10 years, there can be periodic and exit charges. So one of the things we would look at, so a couple, you would generally try to put less than, you would always steer them to put less than 650,000 as a maximum in. And that can avoid that. So that allows for some growth as well. Even if you did pay a small amount in a periodic or exit charge over 10 years, it's 6% on the amount over your allowances. So over 10 years, there's highly likely to be less than 40% on the IHT saving that you're going to make. Is money in a SIP free from IHT? Yes, a SIP is just a self-invested personal pension. Any pensions, any defined contribution or money purchase schemes, they're now called, they're free of inheritance tax because they're written under a trust. If you've got a final salary or defined benefit scheme, they're different. Most schemes are, if you pass away, 50% of the income goes to your spouse. If you both pass away and you haven't got any dependents, young children, the whole lot stops. So for the ones where you're building a pot of money in the SIP, yeah, the whole thing's free of IHT. Many thanks. You're welcome. Yeah, we've recorded the link. It has to go through the various compliance hoops that you can imagine. The SJP want to make sure that I haven't said anything I shouldn't have. So it takes a bit of time to go through that. that process. But then, yeah, we can put the link on YouTube or share the link. Yeah, that's fine. Okay, so if there's no further questions, thank you for listening again. Thank you for giving up your time to log in. We appreciate you showing the interest. And as I say, always here, always happy to help. So have a lovely Friday, enjoy your weekends, and hope to speak to some of you soon.